Welcome to today's video on maximizing your health savings account through a lesser-known FICA tax advantage. First, we'll introduce the concept and why it matters. Then, we'll move through clear comparisons, visuals, and examples so you can take action confidently. Next, here's our roadmap. We'll start with a quick refresher on the HSA's triple tax advantage. After that, we'll compare payroll deductions versus personal bank contributions. Then, we'll expose the FICA loophole, walk through an action plan if you missed payroll, review estimated tax dates, and run through a quick Markdown math example. Finally, we'll test your knowledge with a couple of quizzes and summarize key takeaways. Before we dive in, please note this content is for educational purposes only and is not tax, legal, or financial advice. Everyone's circumstances differ, so consult a qualified professional for personalized guidance. Now let's recap the HSA's triple tax advantage. Contributions are tax-deductible, investment gains grow tax-free, and qualified medical withdrawals are tax-free. This combination makes the HSA one of the most powerful long-term savings vehicles for both healthcare and retirement planning. Moving on, there are two main ways to fund your HSA. First, through employer payroll deduction. That approach lowers federal taxable wages and typically avoids FICA taxes, which include Social Security and Medicare. Second, you can contribute from your personal bank account and later take an above-the-line deduction on your tax return, which reduces your income taxes but not FICA. The key takeaway is that only payroll deductions capture the FICA savings. Next, let's compare the methods directly. With payroll deduction, your HSA contributions reduce your federal taxable wages and typically avoid FICA, which is 7.65% for most employees. It's also convenient because your employer's system handles it. Some states may also reduce taxable wages, but rules differ. With a personal contribution, you still get an income tax deduction when you file, but you do not escape FICA. You do retain flexibility in timing, and state rules still vary, so you should confirm local treatment. Now consider this decision flow. If you have access to employer payroll funding, set up contributions that way to capture both income tax and FICA savings. If you miss that window, make a personal contribution. You still get valuable income tax savings. Additionally, if you earn 1099 or self-employment income, you should plan and pay estimated taxes to avoid penalties, because the HSA deduction does not reduce self-employment tax. Furthermore, understanding FICA is essential. The employee FICA rate is usually 7.65%, composed of 6.2% for Social Security up to the annual wage base, and 1.45% for Medicare. Payroll HSA contributions typically reduce FICA wages, but personal contributions do not. For high earners, the additional Medicare tax and related thresholds are separate considerations, so confirm how your situation is affected with a qualified professional. Next, let's ground this with a simple example using rounded numbers. Assume an $8,000 HSA contribution, a 22% federal marginal rate, and a 5% state rate. With payroll deduction, you save $1,760 in federal income tax, $400 in state tax, and $612 in FICA, totaling approximately $2,772. With a personal contribution, you save the same income taxes but zero FICA, totaling roughly $2,160. Actual savings depend on your rates and limits. Always verify your numbers. After that, here's your action plan if you missed payroll. First, make a direct contribution from your bank to the HSA immediately. Second, track the amount carefully for reporting on Form 8889 and Schedule 1 to claim the above-the-line deduction. Third, if you have 1099 income, update and pay your quarterly estimated taxes to avoid underpayment penalties. Fourth, review your W-2 Box 12, Code W, to ensure you do not double-count employer HSA contributions. Finally, remember to re-enroll or update your payroll elections at the next open enrollment opportunity to capture FICA savings going forward. Now, to keep penalties at bay, follow the estimated tax timeline. Typically, Q1 is due around April 15th, Q2 around June 15th, Q3 around September 15th, and Q4 around January 15th of the following year. If a date falls on a weekend or holiday, it usually moves to the next business day. Mark these on your calendar and adjust for your state's schedule as well. Next, here's a quick check. Which HSA funding method typically avoids FICA taxes for employees? Option A, personal bank transfer to HSA after payroll. Option B, employer payroll deduction to HSA. Option C, employer match only. Option D, credit card reimbursement to HSA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, employer payroll deduction to HSA. Payroll contributions typically reduce FICA wages, while personal contributions do not. Moving on, here's the second quiz. Does the HSA deduction reduce self-employment tax for 1099 income? Option A, yes, always. Option B, no, it reduces only income tax, not self-employment tax. Option C, only if you itemize deductions. Option D, only if you contribute before April 15th. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The HSA deduction reduces your income tax but does not reduce self-employment tax. Therefore, you should plan and pay estimated taxes appropriately if you have 1099 income. Next, let's run the numbers with a simple markdown walkthrough. We assume an $8,000 HSA contribution, a 22% federal bracket, a 5% state rate, and a 7.65% FICA rate. Both methods save the same income taxes, $1,760 federal and $400 state. Payroll contributions add a $612 FICA savings. That gives a total of about $2,772 with payroll, versus roughly $2,160 with a personal contribution, for a difference of approximately $612. Replace these rates and amounts with your real figures to tailor the estimate. As we near the end, remember these points. Payroll funding captures both income tax and FICA savings. Personal funding still reduces income tax, so it remains valuable if you missed payroll. For 1099 earners, the HSA deduction does not reduce self-employment tax, so manage estimated payments. Revisit open enrollment to move future contributions to payroll where possible. Finally, confirm your state rules and keep accurate records, including Form 8889 and W-2 Box 12, Code W. Finally, let's wrap up. When available, use payroll deductions for maximum tax efficiency. If you missed payroll, still contribute personally for meaningful income tax savings. Plan estimated taxes to avoid penalties, particularly if you have 1099 income. Keep thorough documentation and consult a professional for your specific situation. Before we end, thank you for watching. If you found this helpful, please like, share, and subscribe. Also, share your questions and experiences in the comments so others can learn from them too. See you next time.